Okay, so we are on air. Good evening, everybody, and thank you for coming. This is our last Hangout, and I don't have any new topics to discuss, to cover. So this Hangout will be completely questions and answers. As you can see, I already have some questions that were asked on the website. I will address them in due course. But for now, I was wondering maybe you have some questions. So the first question is, for major project 2, you indicated that depreciation calculation for the 5th year was incorrect. I thought depreciation was supposed to be calculated until the useful life of the item is reduced to 0. Okay, the issue is with pharmaceut acquisition, and the issue is exactly here, I believe. In that case, what happens is that investors are joining the company. I mean, they're ready to provide investment into the company, into the project. The project's life is 10 years. But investors expect that if the project is profitable, if it works out, then they will be able to sell their investment within 5 years. And there is information in the description about that. So let us have a look and be more specific. Here it is. So we see that a venture capital firm, Menlo Ventures, is willing to provide financing, $5 billion. And if VC agrees to invest, it plans to exit after 8 years. And I guess there was a typo when the question was asked. Probably you were asking about why depreciation in the 8th year is incorrect. So because depreciation is over 10 years, but the project, because that's what the project will last for 10 years, but investors want to exit after 8 years, that would mean that even when they exit, there still will be a residual value for this project, and therefore there is still non-zero value because the depreciation will be over the period of 10 years, not over the period of 8 years. I hope that's clear. Depreciation is calculated based on the life of the project, not based on the investment horizon of a particular investor. And this is why we have residual value in this depreciation. So I hope that's what this question was about. Okay. Any other questions? Again, today we have only questions and answers. I'm not covering any new material, and so feel free to ask at any moment. We have a couple of questions that were asked in advance, but I wanted to check with you. Maybe you have some questions already. Okay, since there are no questions, people who present, there are 3 questions that were asked in advance. Let's go one by one. Could you explain how to determine revenues if FDA approved on the financing? Okay. So here, if the project is approved by FDA, we know, and it is pharmaceut project, then based on description again, we see that the revenues will start in right, next year. And so $10 billion revenue, it just plain in the description of the project. It says that there will be 10 billion revenue. So if it is approved, that means that the revenue will be 10 billion. Because again, the expected revenue would take into account probability of approval, which was 40%. But here it says, if it is approved, well, once it is approved, then the revenue is 10 billion. And after that, it will be growing at 50% per year and until the 4th year of sales. So 50% growth, 50% growth, 50% growth. And after that, it will be stable. I think the case also mentions that when you will be modeling this, for simplicity, if you don't want to take into account the probability of project getting obsolete, you can ignore it. So that would be simply then 10 billion growing at 50% and then remaining constant. If you do want to take the fact that the project still can become obsolete into account, then of course in 2020 you'll have to multiply it by the probability of still being in the game, and then 2021 again, so very similar to what we were having here with revenues in this approach that we were using when we were evaluating projects separately. But for simplicity, you can ignore this for this part of the project for financing and just assume that revenues are growing at 50% starting from 10 billion. The next question was, why does it say that if probability of being approved is 10%? Because I need this later. I need, when I'm trying to find the expected cash flow, I need to take this into account. These are my revenues, and this is the book value if it is approved. Actually, book value in any case, approved and not approved. But here, in 3 different cases, I have to look at my cash flows separately. If approved, I have one set of cash flows, and for this set of cash flows, I will need to use some information from the valuation and net operating profit after taxes from that was calculated here. That will be only for successful branch. If it fails, then it will be a different cash flow in 2019. And expected cash flow will be probability of approval, 40%. And let's not forget to log it, times cash flow here, plus 1 minus probability of approval. And again, don't forget to log it, times what happens if it fails. And that's how my expected cash flow will look like. And then I will do the same for every year. Obviously, if project fails, there will be no cash flow after 2020 from the venture capitalist perspective, or from the cash flow that will be paid to the venture capitalist. Because once project failed, the VC will leave in 2019 with whatever money VC would receive from the project. So after that, it will be only probability of success times cash flow in case if it is successful, and probability of failure times 0. The second question, can you explain the operating cash flow once more? Operating cash flow, in general, it is the cash flow that I, as a company, receive from the operations. So it should ignore my financing costs and effects of financing. Therefore, for operating cash flow, a good starting point will be earnings before interest and taxes, because this is before financing, and therefore it will be earnings before interest and taxes times 1 minus the tax rate. But then I have to take into account the fact that earnings before interest and taxes have non-cash item, namely they have depreciation. And this is how my operating cash flow should look like. And the last question from these questions that were asked in advance, could you explain how to calculate free cash flow with probability? Is it the same as how we determine revenue and cost under the using probability? I guess the question was about financing part. And in financing part, this is exactly how I just described it. You multiply by different probabilities. Here, when we were calculating cash flows for different outcomes calculated separately, then you would simply use revenues here and costs here, and then your free cash flows will be calculated based on whatever you already calculated. Probabilities are already factored in here whenever they need to be factored, and then you calculate the net present value, and this is net present value if it is approved. Then you do the same thing and calculate net present value if the project is not approved. And then after that, you calculate expected net present value, which is net present value when it's approved times the probability of approval plus expected net present value if it is not approved times the probability of failure, which is 1 minus the probability of approval. So if probability of approval is 10, then probability of not being approved is 90%. And that's how you calculate the expected NPV here when both outcomes are used separately. In the first approach, when we did not have real option, when we had just one-time investment, technically speaking, you could also do separate calculations. It's just here it is easier to calculate everything together because capital expenditure is not contingent on the outcome. We make investment before the outcome becomes known, and that's when you take into account probabilities right here. So this is already expected revenue because you take all probabilities into account. And that means that this is again already expected net present value. There is no need to multiply by probability anymore because probability is already factored in when we were looking at costs. Those of you who want to do crystal ball, what you will get at the end, you expected NPV here, and you expected NPV using crystal ball for two-stage financing. They should be very, very close to each other. If they're very different, you did something wrong. And by the way, if you are not using crystal ball, you don't have to fill anything here. This is just for crystal ball. If you don't do crystal ball, it's enough to stop here and leave everything else blank. Okay, let me move to questions that were asked while I was answering. Okay, that one I already covered. Okay. Expected free cash flow, ignore probabilities in all equity case. I think probably my comment was related to exactly this situation. That's when you were calculating expected cash flow, you did not multiply by probabilities, or some people made a mistake and they multiplied by wrong probabilities, or multiplied both times by probability of success instead of probability of failure. Now, another thing I recommend to check, what sometimes happens, people forget to log. And so let me put some random numbers here. 1 minus 5 minus 2 minus 1. Okay, so people forget to log in their formulas, and therefore they would put B10 1 minus B10. The first formula would look exactly the same, but then after that, notice that it is incorrect because it refers to the empty cell. So when you're making this copy and paste, make sure that you are locking the cell that is the probability cell. Either you can name this cell, and then if I refer to this cell, it will automatically think that I'm referring to the named cell, and that's how it will be locked. And then no problem, it is when it's named, it always refers to the same cell. Or you can anchor by putting dollar signs in front of B and 10. And if you are using Windows, you just click F4 and it will automatically, sorry, my apologies, I didn't hit enter. B4, then I click F4 and it automatically has added these anchors. Okay. Any other questions? Let me check emails. No questions by email. And no questions here. Any other questions? Let me remind you that major project is due next Friday. And then Saturday and Sunday you can spend answering to remaining discussion topics. And I will be busy grading your submissions. I already posted all your preliminary checks with exceptions for people who submitted late, and I hope that I will grade their submissions tonight. Can we also go over the evaluation homework due this weekend? Well, if you have specific questions, yes, we can. Here is this homework that is due this coming weekend. Here you have to calculate the annual rate of return for venture capital investors, and this is the real life case. So you are using real life numbers. You have to find the numbers from the 424B filing with Edgar. That will give you the IPO price. And I tell you, well, if you want it, you can even read the filing, because information about that is also in the filing. But I'm telling you that one preferred share was converted into 12 public shares. So for each share that Accel Growth Fund invested, they would receive 12 publicly traded shares. And the question is to find annual rate of return for this investment. And one of the approaches you can do is very similar to what was done in previous example. You can set up the cash flow, except here it is set up horizontally. You can set it up vertically. And you calculate using the internal rate of return function. You calculate what annualized return was. Now, be careful with internal rate of return function. If you have 2 years investment horizon and you would say, oh, I invested $10 and I received $20 after 2 years, and you set up internal rate of return function like that, it will not calculate annualized return correctly, because your investment horizon is 2 years, not 1 year. And even if you move it here, and it looks like it now covers the period of 2 years, it is still not correct, because there is a problem with internal rate of return function in Excel. If there is nothing in the cell, Excel will skip it. So you have to put 0, even if there is no cash flow. You have to specifically say 0, and then it will calculate it correctly. And now you see your actual return, annual return, is not 100 but 41%. That's one of the typical mistakes that is made by students. And I cannot blame them much, because they would think, oh, I don't put anything, that means 0. No, from Excel's perspective, it is not the same thing. Another example, you could use a more precise function that is not internal rate of return, but it is XIRR. That's the rate of return when you can use specific dates. And many people ask me question, why do we have 2 lines here? Well, you can use 2 different approaches to calculate annualized return, or you can use both columns. In one, you will set up the time horizon. In another one, you set up the cash flow itself, and you'll calculate internal rate of return. So it's relatively easy homework once you find the correct IPO price and correctly identify into how many shares you converted your preferred shares. And obviously initial price, that's easy to calculate. If totally you spend $20 million and you get 2,932,553 shares, then the price of one share will be calculated pretty easily. If I bought a 5-pound bag of chips at $25, what is the price of 1 pound of chips? Okay, we have another question. Okay. The question is about automated part of the project, and it looks like the student thinks that she correctly treated and did not get credit for that. That's possible. Send me an email and I will look one more time at your submission. Maybe you did it right. But a lot of people forget that there is a salvage value that needs to be added to earnings before interest and taxes in year 5 before you calculate your taxes. But I will have a look and maybe you did it right. I'll review it and let you know the result. Just send me an email. Okay. Any more questions? Again, today we have Q&A session and I am answering your questions today. Okay, if there are no more questions, I think we'll end today's Hangout short of 1 hour that I allocated for it. Thank you everybody for coming and good luck with your homework. Good luck with your discussions. And don't forget the deadline for major project is next Friday. And I look forward to your submissions and I wish all of you success. Thank you very much.